Unemployment expectations have dropped to levels only seen during recessions. US consumers' 1 year unemployment expectations tumbled to about 50 points, the lowest since 2008. This kind of major drop in labor market confidence has only happened a handful of times, going back to the 1970s. And every time, it was followed shortly after by a recession. So is this drop today an early signal of an incoming global recession? Or could this time be different? That's what we'll dig into in this video. If we add non-farm payroll to this chart, we can see that actual employment rates follow expectations really closely. That's especially clear in the lead up to recessions. Look at this dip in 2008, or this one in 2001. Both times, unemployment expectations plummeted, and so did actual non-farm payroll. That's what makes this recent dip here so important. If actual employment follows expectations as closely as it usually has in the past, that would spell a crumbling labor market in the near future. But despite the gloomy expectations and negative news coverage, the labor market doesn't seem so bad when you look at how things stand today. For example, look at the unemployment rate, which currently sits at 4.2%. As you can see, that's quite low historically and within the 4 to 5% range of what's considered full employment, one of the Fed's two key mandates alongside stable prices. So, taken by itself, the current unemployment rate is not really cause for concern. Initial jobless claims seen here are also quite low at around 240,000. This is considered to be a very important leading recession indicator. That means it can signal recession ahead of time. And it's true. If you look at initial jobless claims through history, you can clearly see that it tends to rise pretty rapidly before recessions start, going all the way back to the 1960s. But since jobless claims stabilized after the pandemic, this indicator has been relatively flat and remained quite low. So this supports the view of a strong labor market. And here we have non-farm payroll jobs, which measures jobs added to the economy. In the past, this indicator has tended to fall just as recessions begin. We can clearly see that here in 2008 and also in the lead up to the 2001 recession, and so on through history. But today, there's no concerning dip in this indicator, even though the economy is adding fewer jobs than it was after the pandemic, when the economy was restabilizing. It has remained relatively strong at about the historical average and showed no sign of imminent collapse. As we can see, all key measures of the labor market data show it's actually quite strong.